Hello there, Maverick Traders. This is Rob Reinhold, and this is the Trading Room. It's good to be back. I've been out of town for the last few weeks, so let's jump into it. In this session, we're going to be talking about the news of the week. We'll go through the broad markets, then we're going to dial it in and look at the sectors, and then we're going to look for trading opportunities in those sectors.
All trades and analysis in this video are for professional traders only. This video has been released to the public after a delay required by our compliance department. Maverick traders receive this market recap immediately, along with real-time trading support and resources. Maverick Trading is a proprietary trading firm that backs professional stock and options traders with firm capital. Our traders keep 70 to 80% of the profits they generate. If you're ready to become a professional trader, click the apply link in the video description below. Let's break down what happened in the markets today.
All right, let's start off with last week's news. We had just been in a bull market for a very, very long time, and we've been very clear here that until the market changes, then we just need to stay bullish, even if you think it's too expensive, even if you think it's gone on too long, even if you just trade the charts. And so for the first 4 days of the week, actually for the first 4 days and 1.5 hours on Friday, we were just making new all-time highs after all-time highs. Everything was just good. The party was on. And then one simple tweet took the market and really have changed everything. And that was the tweet that new tariffs were going to be put on China. And this was in retaliation to China restricting rare earth metals from export to America. So they went first, America shot back, and here we are. We're now in a new trade war. Now remember, the first trade war, do you remember that in April? Or in March, April, we tanked. We tanked, big falls, a huge spike in the VIX. Is the same thing going to happen? I don't know, but here's what I do know. We were in a very, very low volatility environment. And when we talk about low volatility, we're talking about the VIX. The VIX is a measure of call and put options being bought on the S&P 500. There are not very many puts being bought. What that means is that when the market drops, that the big fund managers must sell because they're not hedged. If they're hedged, then they can actually take some time and say, okay, what should we sell? But if you're not hedged at all, if you're completely long and not hedged, it's going to be panic. And that's what we kind of saw today and likely what we're going to see next week. And then throw in the government shutdown on top of this. This is the second week. And all of a sudden now we're getting delayed reports. This is not a good moment here in the market. Now look, this is all just commentary and a little bit of my opinion mixed into it, but we're going to look at the charts. We're going to look at the price action and see, does the price action match what I'm saying here? As far as economic reports go, you can see we didn't get many because the government is closed. And when the government is closed, we can't issue press releases or statements. The only thing we got was University of Michigan consumer sentiment, and it was basically the same as it was last month. Again, nothing to talk about as far as economic reports go because we didn't get any. Let's jump into the market. If we did this video on Thursday, it would have been all sunshine and everyone having a good time. Wildly different. Dow down 3%, S&P and Qs down 2%, gold making new all-time highs, and then oil down 4%. I want to spend a little bit of time talking about oil because oil broke through the $60 range. Below $60, most of the U.S. oil companies no longer make a profit on a barrel of oil. So this is bad. This is another thing that you could point to that says, hey, you know what? Maybe economic growth isn't doing as well as we thought, or maybe there could be some problems. And if we take a look at the S&P chart, they were ignoring it. The S&P was completely ignoring it, making new all-time highs. But I really want to point to this last week. This last week of price action, this is really showing a little bit of exhaustion. You know, we had a big run. We gap up and fall. We gap up and fall. If I was talking to you on Thursday, I would have said, hey, you know what? I don't love this price action. It overall looks a little weak, but it's just simply because we're out of gas. We're out of gas. We've reached a new short-term top. We'll probably get a little bit of a pullback, and then we're probably going to go higher. That's exactly what I would have told you on Thursday. Take a look at this candle on Friday. You could see we have done some serious technical damage. We're still trading above the 50-day moving average, but we're pretty darn close to it all in one day. We take a look at the Qs, really the same story. We are simply having a big pullback. There's only one candle. What comes after these candles is going to be very important. If we can get some sort of bottom and then a decent rebound, okay, you know what? I'm willing to say, hey, you know what? That was maybe just a pullback. If we don't get that and we just keep dropping, or we base, maybe we spend a couple days basing, I tell you what, I just do not like this market here. But it is premature for me to say that the technicals have turned to a bear market. All I can say is the technicals have turned to where you should be very cautious and at least see that a bearish market could be coming, but at least be cautious. Take a look at the heat map. You can see it was all over the place. So just, and again, wildly different on Thursday versus Friday. Let's talk about where we are. The market outlook, we were in very low volatility, very low falling VIX. Everything was nice. I think that has changed, and I think that low volatility period is over. So what does that mean? That means if you are a net seller of options, what I mean, again, if you're selling naked puts, if you're doing sideways strategies, this is not the market to do that in. This is the wrong market for you to continue to sell puts. It's just the wrong market. Choose another strategy. Do something else. Sit on your hands. Sit in cash. I don't care. But this is not the right market for it. Wait for the market to calm down and settle down. You can get back to your put selling. But as far as right now goes, it's screaming at you, hey, stop. No more. Just cut it out. Sit on the sidelines and come back when it's more calm. This market is very news driven at the moment. We've got the government shutdown that's going to be talked about. And we also got this little bit of news. This actually came out after the market closed, about 1 hour after the market closed on Friday. It was when I was preparing this, that President Trump came out and said that starting on November 1st, 100% tariffs. Now, let me tell you what happened. Everything was closed except the crypto market. Things like Ethereum were already down 10% for the day. It fell another 10%. Bitcoin down 6 or 7% for the day. It fell another 6 or 7%. We did rebound off those levels. We'll have to wait and see what they do over the weekend, but I would not be surprised at all if we see a 3, 4, maybe even 5% gap down. Again, we're going to have to watch the crypto market. It's going to be the only thing that can tell us where the market sentiment is at the moment. But it dropped another 10%. Now, again, on a day like today when the markets fell 3%, okay, that tells us maybe there's another 3% drop that might happen. It has rebounded. We'll wait and see where the crypto market is on Sunday, but I think you've got to brace for a gap down on Monday. We'll have to see what happens. And all of this happened when we are at extremely bullish levels. Bullish sentiment, bullish valuations, everything extreme. We were at extreme levels. And I've been saying for the last 2 months, yes, we're in a bubble. Of course we're in a bubble. There's no doubt we're in a bubble. But bubbles keep going until they pop. One of my favorite sayings, and I had to learn this because I'm a perma-bear, is that bull markets don't die of old age. When I was a young trader, I used to say, it's gone too long. It's gone too far. Things are too high. The valuations are too stretched. Guess what? A bull market doesn't care about any of that. They don't die because they get old. They die because something changed. Has something changed? Yeah, I think these 100% tariffs on China could be a big deal. Now, this is what we know now. Could President Trump walk things back? Absolutely. Has that been his game plan? Pretty much. And we've all heard of the taco trade, the Trump always chickens out trade. If the markets really freak out, he probably backs away from it fairly quickly. But as far as right here, right now, this is what we're seeing. We are not going to get many announcements next week. Looks like we will get the PPI and retail sales. The CPI was scheduled for Wednesday, but that has been delayed to, I think, the 24th, when we're going to get the CPI report. So these economic reports are likely to be delayed. So where does this leave the market? Well, it leaves us at a +1. So we've gone from a +3 down to a +1. Technically is saying, hey, it's time to pull back. It's time to pull back. It's not time to be super bullish anymore. Let's wait and see what happens. Will the market put together a decent bounce? Here's a great thing. A year is very long in trading. If you were to just sit out the next 2 weeks and see what the market did, it's not going to affect your yearly returns at all. If you go in and try to be a hero and try to buy this big pullback and it isn't, yeah, you're going to regret it for the year and it might ruin your year. But as a trader, look, if it's not clear, just go ahead and sit on your hands and wait until the market's a little bit more clear. I've got a -2 on the week. I do think we get a little bit of a gap down on Monday. We'll see what happens after that. But I am very concerned about this market. Very concerned. Let's take a look at the sectors and see what they're telling us. Maybe they're telling us a different story. As far as the sector returns go, we had 2 sectors up for the week. We had utilities and we had consumer staples. And you can see everything else. Healthcare was the 3rd best. So here we have, take a look at this. These are the defensive sectors. These are the defensive sectors. They did the best. Everything else fell about 3%. Energy is the worst. I think energy is in some real trouble here. It's actually my favorite short of a sector. Materials is in trouble too. So we'll take a look at both of those. Let's go ahead and score these all from +3 to -3, see where they are. Utilities was a +3 last week. Look at that. It was an up week. We had a little bit of a pullback on Thursday, Friday. Yes, we probably pull back a little bit more, but I do like the utility sector for loans. Next up is the consumer communication services, and you can see we've broken. We did not hold here. We based here. We broke down. Communication services broke down well before the market did. I mean, take a look where it was on Thursday. It looked atrocious compared to where the market was at new all-time highs. Big break here. This thing is very negative. -2 is where this sits. Going on to real estate. Same thing with real estate. Look at the candles. They were selling off all week long. Remember, the market only sold off on Friday, but these things were selling off all week long. We're going to go from a 0 to a -2 on this. And I want you to see, because I'm going to bring this up here, where we bottomed out in August. You can see we're right at those levels. I can't say that we've broken through those levels yet, but we are very close to that. Moving on to healthcare. Yes, big pullback on Friday. I get it. We're probably going to pull back more, but this thing looks great. This thing looks great. Just let it pull back a little bit. I think this is definitely a sector that you can look for some longs in. Coming over here to industrials. Industrials, big fall. We had this big candle where, I mean, we were like a +1 or a +2, and then one day later, we're at a -2. I don't love to move that quickly on my ratings. I don't, because it's very twitchy, and I don't like to be twitchy. I like to look at things holistically. We're still in this range, so at this point, I'm going to give it a -1. If it slips below that bottom of the range, I'll go to a -2. But for right now, -1 on industrials. We take a look, though, at the financials. The financials did break below their recent lows. And so this one is going to be a -2 because we're not in that channel like the other one was. Moving on to consumer discretionary. Taking a look at this, we can see we had a nice move. We failed to make new highs. Again, the market made new highs. This underperformed, and take a look at this over the last week. It was selling off anyway while the market made new highs. So this is going to be a -2. Definitely looks bearish here. And this one, to me, looks like one of the better sectors to be short. Here we have consumer staples. You can see we based and actually went up for the week. We are going from a -2 to a -1 on this. If the market keeps falling, this is probably where people are going to go run and hide for some safety, but just a -1 at this point. Here is technology. Now, this is where all the strength was. Remember, I talked about new all-time highs every single day. It was in tech. It was in tech. Tech was moving the whole market and holding it up. Everything else was deteriorating underneath. Tech was holding it up. Okay, it got whacked. It got whacked, but look where it is. It's closer to the 20 than the 50. When you take a look at this, you have to say that tech is outperforming. This is at a +1. Look, I expect tech to get worse if the market sells off, but it's outperforming. So we can definitely look here when there's a bounce. Tech is probably going to be the place to be if we get a bounce. And then look at this. This is atrocious. Look at this. Materials. Again, we were at all-time highs on Thursday, and this thing got hammered and hammered again, and we are below our lows in August. So that's why this one gets a -3. This is definitely the weakest looking chart. And then come here to energy. You can see energy did not bounce up. Remember, we are hitting all-time highs in the market. And look at what energy was doing. It broke down on Thursday, even before the market broke down. Big breakdown on Friday. It's above the August lows, so I'm going to give this a -2. So let's see where they all stack up here. So we are moving materials down to -3. That's the weakest sector at the moment. Staples, however, moves up, the only sector that gets an upgrade. And then look at all the ones that fell to a -2. Real estate, financials, energy, consumer, comms services. Industrials moves down to a -1, technology to a +1. Okay, now I want you to take a look at this board. Take a look at where we are. I'm going to go back through the previous couple weeks, and I want you to see how the market has been deteriorating when we take a look at sector ratings. So again, this is 3 or 4 weeks ago. I think it's 3 weeks ago. This is where we were. Look at this strength. Very clear. The only thing that's negative is staples. Everything is very, very strong. And then utilities, real estate, defensive sectors. Again, this is showing us very much bullishness. And then 2 weeks ago, take a look at what happened. All right, you can see deterioration. We're starting to deteriorate, and things like utilities are starting to get a little bit stronger. But again, just melting down a little bit. And then last week, we've got this, and now we've got a -2 and 2 -1s and a 0. You can see, and healthcare and utilities have worked their way up. Defensive sectors, I want you to see that the sectors have been telling you that things are weakening, that the defensive stuff is starting to get a bid. The strong stuff, the technologies, the consumer, the financials, they're starting to weaken, and comm services and materials are already at a -1. This is where we are today. So we've seen this erosion in sectors. It was telling us that, okay, the market is getting a little stretched. Oh, look, no one knew what was going to happen on Friday. There's no way to foresee that this is a black swan event. There's no way to prepare for it. But if we look at charts, and we're always adjusting things for where the charts are, it can actually help us out most of the times with these black swan events. All right, so here we are. This is our trade board. We had 8 trades on last week. We had 3 trades drop off. We had a max gain in Palo Alto. We had a max gain in Nucor. So we had 2 max gains, and we had a max loss on Exxon. Definitely a max loss on this, as it did not break out to the upside. Now, I want to just go through, this is the beauty of this system, is that we're now starting to get less and less bullish. So now we have more bearish slots that are going to be opening up to us. We're now at a +1 is where we are. So now you can see, okay, we now have more bearishness available to us. One of the things I've been talking about over the last month or so is that I might want to be more bearish, but I don't have the slots for it. I don't have the slots available, so I can't become bearish. I am handcuffed by my system to taking my opinion and putting it into work because the slots have to be open. Now I've opened up a few more slots. So you can see I'm going to be filling all my slots. We have 1 -2 in consumer staples, but then you can see I'm using my trades this week to really fill in this bearish one. I'm going to throw a +1 in utilities, but that's it. And you're going to see that now I'm very, very slightly tipped bearish. Very, very slightly, but it's the most bearish I can get. This protects me from the times when I was a young trader, when I was convinced, so convinced that the market was going to crash. So convinced. So what did I do? I went all in on being short. And what happened? The market didn't crash. It had a bounce. And I got hammered. Look at this. It's going to be very hard for me to get hammered. I've still got 3 bulls out there, and I've got 3 bears. We are very, very well positioned here for where the market is. So let's go ahead and talk about some of those potential trades in these sectors. Starting out with the utility sector, here is Southern Company. This has basically been going sideways for a while. And then you can see we break out, we base for a couple days. And then look at this. This candle is beautiful on Friday. Okay, this isn't a fast mover. This moves a couple of dollars at a time. What does that mean to us? Well, let's go ahead and talk about it. I already determined I'm going to be doing a +1 trade, which means I'm basically selling the at the money call and buying a call beneath it. I'm looking at the 96.98. That's probably going to cost me about 65 or 70 cents. If the market changes over the weekend, which again, I do expect there to be a gap, I'll just simply adjust it. So let's say the stock opens up at 97. I'll do a 95.97. Let's say the stock opens up at 99. I'll do a 97.99. So again, I'm just selling that at the money call, buying a call underneath it, creating about 60 delta to 65 to 70 delta. Somewhere in there is where I'm going to be on my +1. If you want to be a little bit more bullish, then just open that up a little bit on your strikes. All right, that's the only the only bull I'm looking at. All the rest are bears. So let's jump into it. Consumer. Here is Deckers. Now take a look at Deckers on a longer term chart. It has been an atrocious stock chart, and we've been basically held here at 100 for months and months and months. We finally have broken down below it, got a lot of momentum here. So as you can see, low base breakdown, just not looking good here. This company is in a little bit of trouble. So I determined already I'm going to do a -1 in this sector. So my hands are kind of tied. I can't be more bearish. I might want to be an idiot and be like, oh, I'm buying long puts. I think this thing's going to 80. I could have that opinion, but because of my system, I'm handcuffed to how bearish I can be. This is the most bearish I'm allowed to be at this moment. So it's a 97.95 bear put. Same thing on the downside. I am simply selling the at the money and I'm buying a put up above it to create a spread. If you want to be a little bit more aggressive, okay, if you got a -2 slot, okay, go for a 96, 93, somewhere in there. All right, materials, another sector that just is terrible. If you want to see how terrible this sector is doing, take a look at all the chemical companies. They are getting destroyed, especially the ones that pay a high dividend, like Dow and LYB. They're now up to like 12, 11% dividends. Those dividends are going to get cut for sure. So in this space, Corteva, this is a agricultural chemical company. And you can see we had a really nice fall here. And then we did a nice bear rally. You can see really nice candles. They even it would gapped up on this day, gapped up on this day. There's nothing but sellers here. Where is this thing going? I like this one down into this 58 area. I think that would be a target for me. But again, here's the problem. I have to honor my slot system. I have to. So the most bearish I can get is this one right here. Looking at a November 21st 65 long put, and then I'm selling the October 60 for a diagonal put spread. Again, this is just the most aggressive I could go. This does not have weekly options, so I couldn't do a vertical spread, but I really like these trades because I love diagonals. Let me tell you why. So let's say that this week I put on the 65, 60, and at the end of the week, let's say that this stock is trading right around 60 bucks. Look at that. It's just breaking down below this point and it's trading around 60 bucks. I love that because that October 60 put is going to expire. I get to keep that money. And then on Monday, I'm holding this November 21st. I've got 4 or 5 weeks to let this thing fall. And if this thing has a substantial fall, I've just got long puts. Now, of course, you can turn that into a vertical spread if you want. But I like to just hold these things because if I get it right, then all of a sudden, big fall, I've just got straight long puts and I got paid a little bit as a cushion in October. I love that trade quite a bit. So that is CTVA in the material sector. And in energy, I like energy short. Here's EOG Resources. Take a look at this. Again, the market topped out yesterday on Thursday. Take a look at what this thing's doing. Basing, falling, rally back up, fell, base, sell off. Okay, for me, if I was super aggressive, target is 100. That's where I'd want to be, target 100. Again, here's the problem. I'm not allowed. I'm not allowed to go that far. I'm going to have to do a different spread. So again, 110, 105. This is going to be about a 1.5, negative 1.5, not a negative 1, not quite a negative 2. So I'm being a little bit more bearish on this one. But again, I'm having to do this because of the strikes available here. So this is the trade October 31st. I'm giving this one 3 weeks, a little bit more time, and giving myself that 105 as the downside. Let's wrap this up. The markets have turned from bullish to bearish. All right. Let me temper that. That's where we are right here, right now. Here's the thing I've learned as a trader. You're going to be wrong all the time. The best thing you can do is just admit you're wrong and go the other way. It's so hard. It's so hard to do, and it's taken me so many years working on that. So right here, right now, on Friday, with these 100% tariffs on China, those could be taken away Monday. Those could be taken away on Saturday. Those could be removed, and then it would be a different market. But right here, right now, you need to look at this market and say, oh crap, we could be in for a March, April period. I don't know if that's going to happen. A lot of things that can happen, but I think you have to at least say, oh crap, this is a possibility when it wasn't a possibility 2 days ago. I wasn't even talking about this. Nobody was. The right place to be was wildly bullish. That was the correct place to be. Now here we have new information, new charts, new trends, new everything. This is where a good professional trader will simply say, the market's changed, I'm wrong, and at least go to a neutral stance. You don't have to go bearish. I think it's too early to go bearish, but at least go to a neutral stance. It's the people that are dug into their outlook, dug into their opinion, that are long, and now maybe they've got a few losses, and they say, okay, I'm going to wait. I'm just going to wait. Those are the same people that said that in February when the market was showing signs of crash. And those are the same people that probably got shook out in April at the bottom because it finally got so painful. Just do it early. Just look at it early and be like, hey, you know what? Time for me to go. Thank you very much for all the profits on the bullish side, but it's time for me to go. I'll come back later. If you are a put seller, if you're an options seller, if you are an SPX, delta neutral seller, this is not your market. This market will roll you over. The best thing you can do, go to cash. Go to cash, preserve your capital, wait for the dust to settle, then go back to doing what made you a ton of money over the last couple of months. Just go back to it. Just take this break. Do not be stubborn. Do not dig your heels in and say, I know I'm right, I just have to wait. Just look, just move your money out, wait for it, and then it's going to be just a great time. Thank you so much for listening to me. Everyone have a great weekend. Goodbye.